All right, welcome back, everyone. Ready for another deep dive?
Absolutely. Always up for a good market mystery.
Well, today we're going deep into the Indian stock market, specifically that pretty wild week back in November 2024.
Ah, yes, when the Nifty decided to take that 10% tumble.
Exactly, that's the one. We've got some fascinating data spanning from November 4th to the 13th, and let me tell you, the foreign portfolio investors, or FPIs as we'll call them, we're doing some pretty intriguing things.
Yeah, their activity during that downturn, especially when we look at both stocks and the derivatives market, it's a real story.
It's like they were playing a whole different game than the rest of us. So that's exactly what we're going to unravel today, see if we can figure out what they were thinking and what they were up to.
Sounds like a plan. Now let's decode those FPI moves.
First things first, though, for anyone who might not be totally familiar, can you remind us why these FPIs are such big players, why their actions matter so much?
So FPIs, right? They're these massive global investors. Think pension funds, hedge funds, those big-name asset management companies. They're the ones pouring billions into markets all around the world.
Got it. They're like the whales of the financial ocean.
Exactly. And because they're moving such huge amounts of money, everyone watches them closely. Their actions are often seen as, well, like a vote of confidence or lack thereof in a particular market.
So if they're buying, it's a good sign. But if they're selling, especially in large amounts, that's when everyone starts to worry.
Right. It can definitely raise some eyebrows.
Hmm.
And in this case, the data you've got there paints a pretty striking picture. During that week in November, when the Nifty was taking a hit, the FPIs, well, they were consistently selling. Every single day, they were pulling out significant amounts of capital.
We're talking some serious numbers here. I mean, on November 4th alone, they sold off over 5,876 core. That's almost 700 million US dollars.
Yeah, you're looking at the highest level of FPI selling in the past 6 months, even more than we saw during, you remember, mention a relevant previous event.
Oh yeah, that was a wild time too. So this is more than just some routine portfolio adjustments, right? This seems like they were genuinely concerned.
It's certainly a signal worth investigating.
All right, so FPIs were heading for the exits. But they weren't just dumping stocks and running, were they? This is where the whole derivatives angle comes in, right?
Exactly. Now, derivatives sometimes get this reputation of being all about risky speculation and gambling. But for institutional investors like FPIs, they're primarily tools for something else entirely.
For managing risk, like a safety net in case things go south.
You got it. They're hedging their bets, trying to cushion the blow if the market keeps falling.
So they're selling stocks, but also using these derivatives to maybe soften the landing, so to speak, even if it sort of means admitting they think things might get worse.
It certainly hints at a less than optimistic outlook, yeah. But to really understand how they might be using those derivatives, we got to talk about open interest, often just called OI.
Okay, remind me, what is open interest again?
Sure, so open interest basically tells us the total number of outstanding derivative contracts, like those futures and options, that are still active, open. It basically gives us a sense of how much action is happening in the derivatives market and whether people are leaning towards thinking the market's going up or down.
So a high open interest means strong sentiment, but it could be either bullish or bearish, depending on which way folks are betting.
Exactly. And here's where things get really interesting with your data. On those days with the heavy FPI selling, you also see a noticeable jump in the open interest for index futures.
Wait, so is that increase in open interest more people betting on the market going up or down?
Well, if you break it down, the increase is mostly driven by the sell volume in index futures,
Meaning?
meaning a lot of players, and this likely includes those FPIs, are taking short positions, basically betting that the market's going to keep declining.
So they're selling off their stocks A&D on top of that, placing bets that the market's going to keep falling. That's a pretty strong statement about their confidence level or lack thereof. But wouldn't that backfire if things suddenly turned around and the market started going up?
It's definitely a strategy that comes with its own set of risks, no doubt about that. But it tells us that they're prioritizing protection against further losses over potentially missing out on a quick rebound. We're getting a glimpse into their mindset during that turbulent time.
I love this. It's like we're piecing together a puzzle, using clues from different parts of the market to figure out what those big players were thinking. But hold on, there were also some days where we saw high buy volume in those index futures, right? What's that all about?
Great point. Got to remember, the market isn't just made up of FPIs. You've got all sorts of other investors with their own strategies and ideas about where things are headed.
All right, walk me through it. Why would anyone be buying futures when the market's tanking?
Well, Could be a couple of things. Could be speculative buying. Some traders think, hey, maybe the market's at bottom. Time to buy low and hope to sell high when it bounces back.
Classic market timing, always a gamble.
Definitely. But it could also be another form of hedging, maybe by other big investors, institutions that aren't necessarily FPIs. They might be using different strategies, maybe buying futures as a way to manage their own risk.
Okay, so two sides of the coin here. Some playing it safe, others trying to ride the waves and make a quick buck.
Exactly. And that's what makes the market so dynamic and, well, a little unpredictable sometimes.
So we've got FPIs selling off stocks, taking short positions in futures, and then this mix of other players either hedging their bets or trying to, I don't know, time the market perfectly. It's complicated, but what's the main message here? What does it all tell us?
Well, if you look at the big picture, both the FPI activity and all that derivatives data, they're telling a pretty consistent story. And it's a bearish one. Institutional players, especially those FPIs, they seem to be bracing for further weakness in the market. They're taking steps to protect themselves. And that level of coordinated action, well, it definitely shouldn't be ignored.
That's valuable insight right there. It means we can't just look at stock prices in isolation, right? By analyzing what FPIs are doing and looking at that derivatives data, we get a much deeper understanding of the forces that are shaping the market.
You got it. Like you said earlier, we're piecing together a puzzle. The more pieces we have, the clearer the picture becomes.
Love it. But before we move on, can we go back and look at some specific examples from the data that really drive home this connection between the FPI selling and their activity in the derivatives market? Just want to make sure I'm really grasping the full picture here.
Of course, happy to dive into the specifics. So let's rewind back to November 4th, that day with the huge FPI outflow. Almost 500 8077 crore, remember?
Yeah, almost $700 million US, a big chunk of change.
Right, a lot of money moving out. And the derivatives data for that day, well, tells a pretty interesting story. Alongside all that stock selling, there was a massive amount of selling happening in index futures too. Over 73,000 contracts.
Whoa, okay, yeah, that's not a coincidence, right? Seems like they were using the derivatives market to double down on their bearish outlook.
It does seem that way, yeah. And if we look at the data, this pattern pops up again and again. Like on November 5th, another day with heavy FPI selling, you see that same surge in the sell volume for index futures. Reinforces the idea that they were strategically using derivatives to manage their risk as the market was declining.
So it's not just random noise. This is a calculated move. It makes you wonder what other tools they might have been using during this whole period, right? I mean, they're not just going to sit there and, I don't know, cross their fingers and hope for the best.
You're absolutely right. They have a whole playbook of strategies. A pretty common one is something called protective put buying. Think of it like buying insurance for your stock holdings.
Okay, so if the stock price keeps dropping, they've got some protection.
Exactly. By buying put options, they're basically setting a limit on how much they could potentially lose. If the market takes another dive, those put options become valuable and can help offset some of their losses on the actual stock.
Ah, safety net. They can still profit if the market goes up, but they're protected if it crashes. Smart. But what about, actually generating income during a downturn? Is that even possible?
Oh, it's definitely possible. One strategy they might use, especially in a volatile market, is called covered call writing.
That one always sounds a bit intimidating. Can you break that down for us?
Sure thing. And imagine they own a bunch of stock, right? With covered call writing, they're essentially selling call options on that stock. It's kind of like renting out a portion of their holdings.
So they're giving someone else the right to buy their stock at a certain price. But why would they do that if they think the market's going down?
Good question. Well, for one, it generates some income. By selling those call options, they receive a premium upfront, like a fee. Even if the market keeps falling, they've made a little extra cash.
Interesting. So even in a downturn, there's a way to make some money. But what's the catch? There's got to be a downside, right?
But the trade-off is that if the stock price suddenly shoots up, goes higher than the price they set in that call option, they might be forced to sell their shares to the option buyer, potentially missing out on bigger gains.
Ah, I see. It's like a balancing act. Guaranteed smaller reward versus the possibility of a bigger one.
Precisely. And remember, this is just one strategy, one tool in their toolbox. There are others. Another one, especially relevant in time of high volatility, is volatility trading.
Volatility trading, that sounds a bit more on the adventurous side, even for these big institutions.
It can be, yeah. Often involves some pretty complex option strategies, things like straddles and strangles, specifically designed to profit from those big price swings. up or down.
Okay, lost me a little bit there. But basically, it's about making money from the market's mood swings, right? Doesn't matter which way it's going as long as it's moving.
Exactly. And during periods of high volatility, like the one we're looking at here, those price swings can create some, well, profitable opportunities for investors who know what they're doing. High risk, high reward kind of game.
Definitely not for the faint of heart. So we've got those protective put buying, the covered call writing, and this wild world of volatility trading. Anything else these FPIs might have up their sleeve?
There's one more thing to keep in mind. It's called portfolio rebalancing. Not so much a specific tactic as it is an overall approach to managing investments.
Okay, I'm listening.
So as the market goes up and down, right, the value of the different assets within a portfolio, they're constantly changing. Rebalancing is about adjusting the allocation of those assets to maintain, a certain level of risk and return.
So during a downturn, they might shift some of their assets to things that are, I don't know, considered safer, less likely to lose value quickly, like bonds or even just cash.
Exactly. It's all about diversification, spreading the risk, not putting all your eggs in one basket. Really fundamental investment principle, and even more important when things get a little shaky.
So maybe they're selling off some stocks not because they're panicking, but because they're strategically adjusting their portfolio to weather the storm.
That's a very good point. Their actions, even if they seem driven by fear in the short term, might actually be part of a much bigger, well-thought-out strategy.
This is why we gotta dig deeper, right? Can't
Yeah.
just jump to conclusions. Just because we see FPI selling doesn't mean it's time to hit the panic button ourselves.
Absolutely. Look beyond those headlines, analyze the data, try to understand the reasons behind those actions.
You know, it's pretty amazing how much we can learn from just a few days of market data. We started with just observing that FPI selling, but now we're getting a sense of all these potential strategies they might be using, including those derivatives, to navigate this downturn.
And we're just scratching the surface here. There's always more to discover, more to analyze in this fascinating world of finance.
I'm ready for more. But before we jump into that, let's quickly recap what we've learned so far.
Okay, so we started by seeing how that FPI selling, coupled with the rising open interest and that significant sell volume in index futures, all pointed towards a pretty bearish sentiment during this particular week back in November.
Right, and then we explored all those potential hedging strategies, things like protective put buying, covered call writing.
Even touched on that world of volatility trading and the whole idea of portfolio rebalancing.
So with all this knowledge, all these insights, I think it's time to address the big question, the one that's been on my mind throughout this entire deep dive. What does this all mean for the average investor, like you listening right now? How can we use what we've learned to make smarter decisions with our own portfolios?
That's the million-dollar question. And it's one we'll definitely tackle head-on in the final part of our deep dive.
All right, so we've uncovered some pretty sophisticated strategies, things those FTIs might be using to navigate a downturn. But let's be real, most of us, well, we don't have teams of analysts or billions of dollars to throw around. So what's the takeaway for the everyday investor? How can we actually apply this knowledge to our own portfolios?
I think the key here is recognizing that we can use the actions of those big players, those FPIs, as a form of market intelligence. It's like getting a little sneak peek into the minds of those who are really shaping the market.
So we can learn from their moves, even if we can't exactly, copy them directly.
Exactly. Think of it this way. If these institutions, with all their resources and experience, are getting cautious, well, maybe that's a sign that we should at least be paying attention.
Makes sense. They're not just reacting emotionally, right? They've got data, they've got experience, they've got resources that most of us just don't have.
Right, but that doesn't mean we should just blindly follow their every move.
Yeah.
Remember, they have different goals, different risk tolerances, even different tax situations than the average investor.
Good point. So it's more about using their actions as one piece of the puzzle, not the whole picture. So if we see FPIs selling off during a downturn, does that mean we should be running for the exits too?
Not necessarily. Remember we talked about portfolio rebalancing. Sometimes selling is just part of adjusting to a changing market. It's not always a sign of panic or, an impending crash.
Okay, that's reassuring. So what are some practical things we can take away from all of this?
Well, first, it really underscores the importance of diversification. If even those big institutions are spreading their bets, it's a good reminder for the rest of us to do the same.
Don't put all your eggs in one basket, right?
Exactly. Second, keeping an eye on that derivatives data. It can be like an early warning system. If you see the open interest in index futures spiking, particularly on the sell side, well, it could be a sign that sentiment is shifting.
Like a canary in the coal mine for the stock market.
Yeah, I like that analogy. It's not foolproof, but it's another piece of information to consider.
Diversification, watch the derivatives, anything else.
This one might sound obvious, but it's crucial. Don't panic.
Yeah.
Just because FPIs are selling doesn't mean you have to. They might have very different time horizons and investment goals than you.
Right. Got to think long term.
Absolutely. And finally, don't forget about the flip side. Sometimes, when everyone is running for the exits, well, that can create opportunities for those who are patient and have done their homework.
So those buy volumes we saw in index futures, maybe those were some savvy investors trying to buy low.
Could be, but it takes careful analysis and a good understanding of your own risk tolerance.
This is why I love doing these deep dives. It's not just about understanding what happened, but about figuring out how we can use that knowledge to make better decisions.
Couldn't agree more. We want to give you the information and insights you need to navigate the markets with more confidence.
Well, I definitely feel more equipped now to understand what's going on behind the scenes. Any final thoughts you want to leave our listener with today?
Just this. Keep learning, keep asking questions, and never underestimate the power of understanding market sentiment. It's like having an extra tool in your investing toolkit.
Great advice. Big thanks to you for walking us through this incredible deep dive. And to you, our listener, thanks for joining us on this journey of discovery. Remember, knowledge is power, especially when it comes to your finances. So keep digging deeper, stay curious, and we'll catch you on our next deep dive.